Hello investors, today I want to talk about bank stocks. Are bank stocks undervalued in the UK? So to begin with, we'll look at RBS, then Lloyds and Barclays. I think overall banks have been fairly beaten up towards the end of 2018. They're sort of recovering now going into 2019, early month of 2019. But they've sort of been priced according to the lower end of their prices, I believe. Only they bottomed out last year. So first up, we'll have a look at RBS. We can see that on the 5-year view, they are much lower than their peak of even in 2014. So they bottomed out at around, if we go to a closer view of a 3-month view, we can see that they dropped sharply in November, all the way from 250 right the way down to 211, and then again in 27th of December they got down to 204, and 11th of December they got down to 20. Now they're all the way back up to 237. I think there's a few reasons for this, and even though we had the Brexit vote the other day, which didn't go great as they rejected the deal, I feel like the prices of these bank shares have already priced in a hard Brexit. So although there will be volatility, I don't feel that they will be hit as hard by any Brexit decisions. I also like the investment that RBS Group are doing. They own a 25% stake in Loot, which Loot is a startup company specializing in digital current accounts, targeting a younger demographic. It is 100% online, no branches or anything like that. Has no fees for spending on abroad, which appeals to foreign students or students going on holiday, anyone really. It's a good feature to have for young people who travel. It also has excellent money management built in, which again appeals to students who like to keep on track of their every single pound counts. But so the RBS have also recently settled a massive legal issue of worth £3.6 billion in the US for the US Department of Justice, and this was their last sort of big hangover from 2008, where they got caught up in the subprime mortgage crisis. So they're sort of dealing with these legacy issues, and this is sort of what would be one of the last ones that they'll have to deal with, which is fantastic for the company. It's fantastic news. So they are getting towards the end of that. They've also recently restarted their dividend payment for the first time since the 2008 financial crisis, which was back last year. It was only an interim 2p per share dividend, which is very small, but it signals intent by the bank to get back to paying dividend. And a projected dividend by the end of 2019 is 10.6p per share, which is covered 2.6 times by earning, which is perfectly doable and very comfortable. The share has a book value of 288p, and they currently only trade at 237, and this gives it a forward PE ratio, price to expense ratio, of just 9.2, which again is undervalued for a share that makes so much money. RBS are sort of powerhouse of UK banking, owning NatWest as well. But as you can see down here as well, the headlines for RBS are that they seek to possibly buy themselves back from the government, because that is one issue with RBS, is the government owns 62.4% of the entire shares of the Royal Bank of Scotland, and they bought them at £5 per share as part of the bailout deal for the 2008 financial crisis. So that is one thing that is a negative for the Royal Bank of Scotland, and possibly could stop them ever reaching that point of great growth, because they're going to have that hanging over them, that the government are looking to sell 62% of the entire group's shares, which is a lot. But this is fantastic news, the fact that they're looking to buy back shares with excess capital from the government, and this would also increase the share prices. Reducing the government's share of the group is great news. But I personally have invested in RBS. I have a small position in RBS at the moment, but it's going well. I invested in the dip. I got lucky. I invested in around the dip, so I'm happy with RBS. I'm happy to hold RBS through Brexit. RBS is my pick for the top bank at the moment for UK banks to invest in. I think it's very undervalued. So the next bank we're going to look at is Lloyds. So Lloyds Banking Group is is another unloved banking stock, but I feel like if you can invest long term, there's huge potential for recovery. So this is a 5-year view, and we can see they were trading all the way up around 90 back in May 2015, but now they're trading at about 56p per share, and this is better than previously where they got down to around flat 50 per share. But as you can see, there is quite a lot of volatility in the Lloyds stock, but this is over a 5-year period, so if we take it down to a 3-month period to give them a closer view, but as you, again, there is still a lot of volatility in the Lloyds stock, but it has a forward PE of just 7 and a dividend yield of around 5.5%, which is well over the 4.5% average of the FTSE 100. There has been questions over Lloyd's bad debt, however, and this is something that people have been warding off investors, but they easily passed the Bank of England's stress test, and their balance sheet was fine for that, so I don't think there should be too much concern over that. And the good thing about Lloyds is it's not a prospective dividend, that is their dividend yield, unlike the Royal Bank of Scotland where it's prospective that their dividend they will pay a dividend. They have not actually confirmed paying a dividend. Lloyds have been paying a dividend for quite some time now. But again, I think Lloyds is another unloved stock that's been fairly beaten down by Brexit and the sort of fears around Brexit. So I do think that the Brexit has already been priced into the share price of Lloyds. It won't drop too much further, but obviously you never know with stocks. So I think to buy and hold for a long-term perspective with Lloyds does offer some potential for great growth. And another bank is Barclays Bank, which has fallen a massive 18.64% over the last 12 months, which is way more than the FTSE average has even fallen during all of the uncertainty in Brexit. So this is another massively unloved bank stock, but it has a 52-week high of 220, and it's fallen all the way down to 145 in late December, but has recovered to around 160 now. But so that's a 5-year view, so obviously they're trading at about 300 nearly in July of 2015 and shot all the way down to about half of that now. But if we take a closer view, as you can see, in late December they were all the way down to 145 per share, and they have recovered to 160, so this is good. But this is good growth already, but whether that's sustainable, I don't think that level of growth is sustainable in a couple of weeks. But again, I do feel that their book value for the share is reported at around 260, meaning there's a discount on book value right now, a massive discount on book value, which again offers that space and that potential for long-term growth. And they also showed a 23% year-on-year third quarter earnings increase in 2018 compared to the same period of 2017, and their forward price to earnings ratio is again just 6.4%, so another very low price to earnings ratio for one of these bank stocks, which again shows that it's quite undervalued at the moment and has potential for growth. So in my opinion, overall, these banks could be considered risky short-term investments, as there's potential turmoil around the UK economy and Brexit and lots of different things, and there is definitely going to be a lot of volatility. But I'm keeping my RBS investment. I'm holding on it. I think the long-term potential for that is fantastic, and if you can afford to buy and hold long-term, I think all 3 of these bank stocks are worth considering for the portfolio, especially including the dividends. If you're looking for pure dividends, I would say Lloyds is probably the best bet. But Barclays only have a dividend of 1.8%, so that is quite low for a bank stock. Lloyds is 5.5%, but RBS should catch up Lloyds soon as well. So, but again, that's just perspective. So Lloyds, if you want a guaranteed dividend, Lloyds is probably the best bet for that, for a dividend portfolio. Anyway, thank you for watching the video. Like, comment and subscribe. Thank you very much.